I can't tell what's worse, the fact that the markets can breathe a sigh of release now that a no-deal Brexit appears to be off the table, or another 3 months of a waiting game. How do markets respond?
I think markets will respond positively to the increasing certainty that the no deal is off the table. But that's not a given at the moment. I would have thought that markets, and we might come back later in the program to that, would have responded much more negatively to the trade wars and to all the uncertainties that we see in the world. But of course, with ultra-low interest rates, the way that they're positioned pretty much everywhere, markets just haven't given, despite the threat of recession, despite all the political uncertainty. So I think this is a bit of a sideshow. It's really all about interest rates.
It's a sideshow, but actually, is it not interlinked with what the monetary policy is? If you took away the threat of a no-deal Brexit, or maybe even a Brexit, does it change how dovish central banks should be?
I don't think so, because much of the damage, the underlying economic damage, is not dependent on that no-deal scenario over the next few weeks. It's really all about the uncertainty, and you've heard me say this many times in the show. What's the worst is uncertainty for markets and for people who put real money to work when they invest in industrial projects and others. And we've seen a pretty strong decline in all that economic activity. The service sector in the UK has been very weak. German economic activity is obviously being impacted by the trade war. That's structural, that's medium to long term, and that's what central banks have to respond to.